Hello, and thank you for joining us today for our webinar for Your Eyes Only, 2023 CRE Insights in Region 1 with CCIM Institute Chief Economist K.C. Conway, CCIM, MAI, CRE. We'd like to take a moment to thank and recognize the sponsors of all the chapters in this region. It's with their year-round support that we are able to bring you programming like this, as well as all the other exceptional events you've come to rely on. We'll begin the session promptly at 2 p.m. Central Time and noon Pacific Time. Thanks again to all of our chapter sponsors. Our webinar for Your Eyes Only, 2023 CRE Insights in Region 1 with CCIM Institute Chief Economist K.C. Conway is about to begin. Hello, my name is Karen Koppel. I'm the board secretary for the Oregon Southwest Washington CCIM chapter. and I'm a commercial real estate broker with MAI Cascade in Bend, Oregon. Welcome to today's webinar for Your Eyes Only 2023 CRE Insights in Region 1. We're happy to share this webinar with everyone in the industry today. For CCIM members, this is just one of the member benefits that are designated to help you adapt and thrive in 2023 and beyond. Joining us today is CCIM Institute Chief Economist K.C. Conway, CCIM, CRE, MAI. He's going to arm you with the knowledge that will help you understand where the economy is and where commercial real estate markets may be headed in Region 1 this year. Please feel free to ask questions throughout using the Q&A tab. We'll be answering as many questions as we can at the end of the discussion. If you are experiencing any technical difficulties, please use the chat feature to ask for help with that. The recording and accompanying presentation will be emailed to all registered attendees. K.C., welcome and thanks for joining us today. I'll turn the show over to you.
All right, let me call up the slides here real quick. Here we go. All right, let's see if I can just reduce one thing here. All right, appreciate the opportunity to be with everybody. I'm in, I left warm 75, 80 degree weather in Atlanta. I'm in Chicago today. So appreciate the opportunity to be close to the Institute. So we'll run through here. I also want to thank my business partner, Beverly Keith, and CCIM Communications for helping us with a little bit of fun here. Our theme being kind of a James Bond one. This one's for your guys' eyes only. Actually, you can share it. I also want to welcome our Montana chapter. I had an opportunity in February to go out to their inaugural event as they kick things off. It was an incredible start, over 100 people, great venue. Michael Reams and all the team out there did a great job. So welcome Montana with your own chapter now. All right, so we're just going to go to slide 4. Here's my normal disclaimer, protecting the Institute. Here, y'all know who I am, but in case you don't, here's a little bit of my bio. So here's our cover slide for Your Eyes Only, kind of the emerging trends, what we're seeing. My overall theme, if you've been following me at all on LinkedIn, knows I'm pretty grumpy and pretty bearish on the Fed right now. What happens when the Federal Reserve breaks the economy? That's what they've done. Congrats, they win the trophy. And we'll explore a little bit about what that means for us going through the rest of the year. So my top 5 things that I'm going to do here, I'm going to look at the Federal Reserve, inflation metrics, confidence measures, recession, a little bit about CRE performance, what by property type. And there was a great piece that was recently in the Wall Street Journal last week. The U.S. needs economic regime change. And what they really pointed out in this article was there is nothing is as expensive as free money. And this is the lesson the Fed didn't do before it started this whole exercise. It really goes back to 2009 and 10 when they started using their balance sheet. When I was at the Fed 2005 to 10, as you'll see in a graphic, the balance sheet wasn't even at $1 trillion. And now we're headed back over 9 trillion. And I don't know, maybe we're going to 10 to 20 trillion dollars with what the interventions going on in the banks right now. So we'll talk about each of these. These are the 5 overall things. So let's start with the Federal Reserve. So early in my career, like many of you, I was taught that everything we needed to know about real estate was in the LLL acronym, location, location, location. And what I've learned over the course of my career is that it's not LLL, it's LTC, location, timing, and capital. Timing is terrible right now, and capital is locked up. And that's what we're going to have to deal with through this year. We have sellers that still think their properties are worth 5 cap rates, and we have buyers that are saying, no, have you seen what's going on with the capital markets? Try a 7 or an 8. And the term we're going to be fatigued over this year is maturity defaults. So anybody that's trying to finance a new deal or that has something that's maturing in the next year or two, you're probably going to find that the bid, if you can find a lender, is not going to be 70% loan to value, but maybe 50% loan to value, and only for the best stuff with lots of guarantees and at interest rates that are probably 50 to 75% higher than what you've been accustomed to. So if James Bond were on the FOMC, he would be Dr. No, saying no more interest rate hikes. And on the chart on the right there, you can see with the red line to 2022, what the Fed has done over the last less than 1 year is essentially raise interest rates at the highest, quickest, and steepest level that we've ever seen. So the yellow line goes back to the, the S&L, I'm sorry, goes back to the subprime mortgage crisis, and the light blue line next to the red was the 1970s and 80s. And so you can see we've blown way past that. And to have a central bank that doesn't stop to assess damage or to ask a fundamental question that we learned from Silicon Valley bank failure. And it wasn't that they were engaged in risky behavior or didn't understand things. The Federal Reserve actually induced them, because they were a venture capital tech lending bank, to put their assets in more conservative instruments like fixed interest rate treasuries. And so if you look at the amount of fixed interest rate instruments that banks hold, when you raise interest rates, from a we were a quarter point to now at about 5%, you decimate the value of those instruments. And so to not understand what that did to the asset side of the balance sheet compared to liabilities, and we're going to see many, many more bank failures, especially as we discover commercial real estate. And so I put the chart there of the Fed meetings, and I want to point out we don't get a meeting coming up in April. So it's going to be May, June, and July before we really see the Fed come back to the table, do some forensics on Silicon Valley and their interest rates and what's going on with commercial real estate and their annual bank stress test. And I fear this is the 3-month period of time we're going to discover whether we go into a very severe recession. We're going into one if we're not already there, or whether they just collapse the American economy. But if they don't get what's going on and the damage, destruction they've already done, we're in very serious trouble. And our industry is very capital dependent. So I encourage you, if you have any transactions, any business to conclude between now and May, get it done, because I think it's going to be very ugly May, June, and July. All right, this next slide, slide 7, bank crisis results from Fed rate hikes. Every bit of this was foreseeable. I was in the Federal Reserve 2005 and 10. I was at the New York Fed. All the lessons that we should have learned. CRE concentration risk, or any kind of concentration risk, the balance between assets and the balance sheet between assets and liabilities, live and let die. That's what we're going to find the Fed is going to do here, May, June, and July. Are they going to let this economy live, or are they absolutely going to kill it? And now it is about quantitative tightening with the backdrop of a banking crisis. And I don't think you can continue quantitative tightening with that type of background. So in the center graphic there that looks like a big Easter egg, we have had 2 of the 3 largest bank failures in our nation's history in the last 30 days. Now, all those little dots and whatnot are all the smaller 500 type bank failures that we had during the Great Recession and subprime mortgage crisis. And to start out with $100, $200 billion bank failures is a complete failure of bank supervision. And on the graphic on the right here, you'll see really what the problem was with Silicon Valley Bank, and was trickled all the way through into First Republic and even over into Europe into Credit Suisse, is banks have to hold assets in different maturities, different rate structures, and different risks to offset the liabilities, which are deposits. So generally, we break them into held to maturity and held for sale. And across that graphic at the top of slide 7, you'll see the 2 in different colors. So the available for sale are the tan colored, and the held to maturity are the dark blue. Those are your treasury instruments that the Fed kind of encourages the banks to hold. Look at what happened here, really in the first quarter of this year, really March 9th, March 10th, was the value of these assets with the Fed rate hikes just plummeted. They weren't worth anything. And the FOMC committee did not stop to ask bank supervision what's going on with the health of our banks when we raise rates 8 or 9 times. What's happened to the value of the assets compared to their liabilities? And if they had even read the 10K report from Silicon Valley Bank that came out in January, in that 10K report, Silicon Valley Bank reported to the SEC that if we have to mark these assets to market, which they're required to do under the situation because of the interest rate hikes, we are insolvent. That was over a month, 6 weeks before it failed, and no intervention. There was total disconnect from monetary policy and financial stability. That can't continue. That's why I've been so harsh on the Fed. This is the most incompetent Fed, even before Silicon Valley Bank failure, that I've seen in my entire adult career, and I think since World War II. So very, very critical. This hopefully will give you some backdrop here to look at. So what is the Fed planning on now? So this chart on the right, Chairman Powell is kind of the man with a golden gun. He can just shoot at anything he wants in the economy, housing, mortgage bonds, banks, you name the industry, he can shoot at it. So if you look at on the left there, you can see the great financial crisis. And this is when the Fed rose the balance sheet from when I was there, 2005 to 10. In 2008, we went from $1 trillion to we said, hey, wow, we have this new tool called a balance sheet. Let's just blow it up. Let's take it up to $4.5 trillion. And remember what I've said to you before, the Fed makes nothing, it sells nothing. So where does it get the capital to put assets on its balance sheet? It calls Treasury and says, print me some money so I can go buy stuff in the market. It's a fiat currency. They were doing printing of money just like Congress on the fiscal side. So we took it up to $4.5 trillion. Then we thought we had good times there, the horizontal green bar there, where 2015 to 2020, right up to COVID, we thought things were fine. We're cruising along. We've averted all problems. And then COVID hits. And we see what's happened now with the Fed's raising its balance sheet, all during COVID, going from under 4 trillion to 9 trillion. And now they're back increasing because of their intervention in the banks. And the Fed, whether they've implicitly or directly implied they're going to backstop every bank's deposits, is the Fed now going to take its balance sheet to 10 trillion, 15 trillion, 20 trillion? Where's the end of what this means? And so what we all get now, that we could have all gone back and learned in Econ 101, is that higher interest rates equal lower values for everything with a fixed rate. That's what we understood about bonds and why you don't invest in them in a rising interest rate. It also affects us in commercial real estate. So here's why this matters. On slide 9, we need to be concerned with who holds our debt and who we're going to ask to continue to buy new printed debt. And this may surprise most of you, but Japan and the United Kingdom hold twice the amount of treasury debt by the US as all of China. So we better pay a focus to what's going on in Japan and UK, more so than even China, because Goldfinger is really in Japan and the United Kingdom. I was surprised to look at how high someone like the Cayman Islands or Island ranked in holding our debt. And the reason these other countries and these smaller economies hold our treasury debt is they need it for currency exchange. So if the dollar is the reserve currency, you need to hold assets that are in the reserve currency denomination. So that's why Ireland or Switzerland, or even if you go to Vietnam, why they hold treasuries is it facilitates currency exchange here. So if the Fed's not paying attention to this one, oh my God, we're in real serious trouble in terms of who's going to continue to buy our debt. All right. Many of you have heard the game Monopoly, and if you actually go to the rules in Monopoly, you'll see in that box at the top that it talks about what does the bank do in Monopoly when the game goes on so long that all the printed paper money is gone. Well, the bank never runs out of money in Monopoly. You can tear up scraps of paper, you can print your own money, and you can keep on going. That is what we have today. We have a monopoly bank. We don't have a central bank that is acting in good behavior or good faith at all. And so at the upper right there, you can see where the Fed's intervention, its emergency lending now broke $300 billion, and their balance sheet now has gone back up. It's over 8.7 trillion, headed back above 9 trillion. And I think by May, June, or July, they could breach $10 trillion again. And at the bottom there, we get this. The more the Fed purchases, the greater the money supply grows because they're putting money into the economy, and that results in inflation. And for the Fed to have gone through COVID with Congress, and Chairman Powell never spoken up or given a speech that says, we have not done the math, we have not done the exercise to figure out the unintended consequences of you, Congress, and us Fed printing over $20 trillion of money into the economy. It was a natural conclusion. At some point, we were going to deal with a massive inflation crisis. All right. CRE losses are the next item to hit the banks post the Silicon Bank failure. So when this came out by the American Banker, I did a LinkedIn post, and you'll see on the left there, it says CRE losses next for banks. Bleep, yes. I mean, that was like the worst headline I've ever seen the American Banker publish. Of course, we are next. With the other fixed interest rate asset that's in the banks on the balance sheet, whether it's mortgages, whether it's Freddie Fannie, multifamily debt, GSE stuff, whether it's construction loans or it's mini perm loans. The banks went into the COVID already with CRE concentration, which meant that over 300% of their capital was in commercial real estate. Now think about what happened to Silicon Valley Bank. It had around 300 to 400% of its tier one capital, its equity, 10% of all of its assets in fixed interest rate treasury bonds. What happened to the bank? Gone. What do you think happens to real estate concentrated bank with 300% of its capital in commercial real estate loans? I'll show you where I get a number that at least 200 banks are probably insolvent or ripe for failure between now and the summer or the end of the year. The other thing is on the right there, we'll get into it in the office, but look at big entities like PIMCO, big institutional entities that are saying, look, we have these fixed interest rate maturing office building loans. They've already dropped 20% in the value. We have no equity. We're giving them all back. So do banks like to lend on assets or an asset type whose value is declining? Remember, cap rates are going up because of the cost of debt, or the asset isn't in demand like office. Do they like lending on that? No, they run like the bleep from that. And that's what we have to face. That's what is going ahead on commercial real estate. All right, the Texas ratio. I know I've talked about this at least once or twice before over the last 5 years as your economist, but it's important we bring it back to focus, because as you're engaged with transactions, you need to understand the counterparty of the buyer or your own seller and who they're banking with and when the date of closing is, and is it around a May, June, or July Fed FOMC meeting. And what the Texas ratio is, very simply in the yellow highlighted in the first paragraph on the left there, it's determined by comparing the total value of at-risk loans to the total value of funds the bank has on hand. And so that's, generally they have 10%. And so if their risk assets get anywhere near 10%, they're insolvent. That's what happened to Silicon Valley Bank. It's what happening to First Republic. It's what happened to Silvergate. It's what's going to happen to a lot more banks. So I picked Montana here because Montana, you're doing a great job. So given that your new chapter, we're going to give you some good news. So you can go to the Texas ratio. Deposit accounts maintains this with LendingTree. You can look up every bank. You can sort it by riskiest or healthiest. So Montana, I did there in the center, the riskiest banks in Montana, and there's only one that has a Texas ratio above 3%. You can get up to 5% without a lot of trouble. You got assets to liquidate, you can raise capital. But when you get to 5% or above, you need to raise capital. When you get anywhere near 10% or above, you're basically insolvent. So Montana, good job. Your bank's in pretty good shape. The One First Interstate Bank is, just keep an eye on it if you're doing business there to make sure it doesn't suddenly slip up to 5. So you could go look this up. I would encourage you with every entity you're dealing with in a transaction to go look up the bank parties in the transaction for both the buyer and seller, look at their ability to fund loans, look at if they're a CRE concentrated bank. You need to know this stuff so you aren't surprised sitting at a closing table or the week before a closing table and finding out that the lender pulled out. So this is one of my best solutions for you today. So let's pivot from the bank side. Hopefully I've said enough and showed you my ire with the Federal Reserve right now. Let's talk about inflation, because one of the things that's going to be confronting the Fed is whether inflation is tamed, whether they have to continue to raise interest rates. So we saw they just moved a quarter basis point, just making this problem worse. And I think when they don't have a meeting until May, the jobs and the inflation numbers that we're going to get for March and for April and going into May are going to show just like what the Fed saw when it didn't move in January of 2022. And it took February off for Groundhog Day to hopefully have the groundhog tell them there was no inflation shadow. Then they came back in March, did a token quarter point. They took April off for spring break, and they came back in May and said, oh my God, we really have inflation. And they did 50 and 475 basis point rate hikes. That's my fear that we're set up for, because I don't see inflation abating. And as I've said to those of you I've met with over the last few months in the summer, was the only reason inflation looked like it peaked and went down over the summer was we did this thing called the Strategic Petroleum Reserve releases from oil. So we drained out most of our reserves. We brought the price of energy down. We made consumers feel good. We head faked the media and the media economists that inflation had peaked, and we hadn't at all. And I told you, watch what happens when that gig is up. And we no longer have the reserves to release to bring the price of energy down. That's what we're going through now. Energy inflation comes back. But let's look at the two big ones. Producer price index in January. So the January number was 0.7%. This came out days after the February 1st meeting of the Fed, which they said, we're going to cool it from 50 basis points down to 25. And just a few days later, we get producer price index as hot as it was in any month in 2022. It came back down in February here in the data we got a week ago, but only for one reason. Y'all watch what was happening to egg prices. We had an avian bird flu that killed a lot of the bird stock in the world. That's abated. We've been rebuilding the bird stock around the world, and egg prices dropped 32% last month. And think of what eggs go into: every food item, every food processed item, into plastics to make them biodegradable and ESG compliant. And when you drop egg prices by 1/3, if you take that piece out, our producer price index would not have been negative in February. So it's so important to understand and go behind the scenes and what's understanding the volatility in these numbers, because it's not like, inflation got cured over the summer. It was Strategic Petroleum Reserve releases that was going to come back and bite us. Look over and, the other thing in producer prices, look at the categories that are causing the most inflation. Look at food running over 10%. Look at construction, so running over 20% there. So it's important we look at these items. I'm going to talk about the super core numbers, which are wages, services, shelter, and food. Those 4 items account for about 80% of what's real inflation, and they're running over 10% in aggregate. So until those 4 come back down into a 5% or less range, we haven't tamed inflation at all. Look at consumer prices. In January, it came in a hot plus 0.5%. Then in February, it only slowed 1/10 to 4%, but we were still over 6%. And again, look at who was causing the problem. It was food. And look what was happening to energy. It was rising as we came off of the Strategic Petroleum Reserve. Then here I break out here for you on slide 14, some of this CPI in detail. So the BLS has these charts built for you, so you can just click on the item on the left there. So you see all items in the red line and see that they think is coming down, but then look at the shelter, the blue line. Shelter is still going way up. So we're still seeing that over 8%. That can't continue unless have tamed inflation. Look over at the right, food at home. That's groceries. It's not dining out. Groceries are running over 10%. And so you can see I put both the shelter and the all items and the food in the green line item there. This is what the Fed should be looking at when they're saying we've tamed inflation or not. This is what Jim Bullard gets on his desk and screams at them that they don't get and understand, because you've got this academic monetary policy that's not dialing in to the fiscal policy and what's going on in banks and the real economy. So this kind of can show you why I'm concerned and what's the logic going on in my brain, that we haven't tamed inflation at all. We've got a lot of it still coming. So what's the Fed going to do? Are they going to continue to raise rates to try to stop inflation, which isn't demand driven, it's supply chain, and they're making it worse by what they're doing? And are they going to cause a banking crisis and ruin the economy? And the Fed better figure it out. They've got a matter of weeks until their May meeting to figure this out, or we're in real trouble. All right. I also look at earnings reports, most of you know, to look at the reality of inflation. So here in the first quarter for the year-end earnings, I looked at something like Domino's Pizza. They got inflation from wage drivers, from the cost of the dough, the wheat. So remember, we destroyed and lost 60% of the world's wheat last year. We lost half of that from, or 30% of the world's wheat crop from the Ukraine-Russian war. And then we lost another 30% because of the droughts in the US and Europe. So we lost 60% of the wheat crop. It's going to get pretty hard to continue to make pizzas here very long, or the prices are going to go way up. Look at what Domino's is already doing. They're paying you $3 to go pick up the pizza. Just imagine that. Could you have ever imagined that going back 5, 10, or 20 years ago, that someday Domino's would pay you $3 to go pick up the pizza because of inflation? That's real inflation. I cheat and I use Seeking Alpha. They're a great resource. They're free. You can sign up for it and get their calendar and their earnings releases, and it's a great way to stay on top of it, and then to send you push out reminders if you're wondering how to do that on the earnings. All right, consumer confidence. Every economy functions on psychology, and it's a 3-part psychology: the consumer, small business, and housing. And if any or all 3 of those are depressed and off of their medications, we're in trouble as an economy. So look on the left of the University of Michigan. So the University of Michigan consumer confidence looked like it was coming back in the summer as energy prices came down, but we all know why. It's because it was a head fake on energy prices from the SPR releases. But look what's happened now as the SPR is over with, and we see the banking crisis and we see the inflation numbers. We now see the the University of Michigan consumer confidence starting to tank again, going back from 67 into the 63 range. Its all-time low is December of last year, below 60, and we're headed there all over again. On the upper right, the NFIB, National Federation of Independent Businesses. These are our small businesses. In small businesses, most of their debt is variable rate. So they're getting crushed under these Fed increases because they don't have a fixed 4% loan or 3% loan like you do on your house mortgage and not seeing any increase in your house costs. Theirs is variable, and they're not dealing with just 6 to 8% interest rates inflation. Try 12 to 20%. Because it's all variable or they're putting it on their credit card. Why should we care about these small businesses? Because they occupy a lot of our real estate. About 40% of all of our commercial real estate is occupied by a small business. Then look at housing on the bottom, the NHAB Wells Fargo Housing Market Index. Look what's happening there. We are in the worst housing recession, worse than 2008 and 9 for different reasons than we've seen probably in our country's history. And here's my leading indicator where Dr. No, if he was on FOMC or the NHAB Wells Fargo Housing Board, he'd say, no, this can't be happening. It's cancellation rates. So KB Homes, a very well run, very well managed public home builder, they've experienced and reported in their recent earnings that they had a 68% cancellation rate. And what happened is everybody that contracted for a new home 3 to 6 months ago at sub 4% money now is seeing it have to be underwritten at 6.5 to 7%, and they don't qualify. And that gives them an out in the contract, and they have buyer's remorse, and they're panicked about the cost of the payment, and so they cancel. And so when you see this kind of cancellation rate by well-run public home builders, this is what's happening in the housing industry. In 2008 and 9, we built too many houses and thought we had sold them to people that made $10,000 and promised that they could make the $500,000 mortgage, and it would never happen. Now what we're seeing is people that and builders that had responsibly engaged in pre-selling and contracts and underwriting, they see that interest rate double in about a 90 to 120 day period while the house is being built and their industry is decimated. So this is my leading indicator. Watch the builder cancellation rates in public home builders to tell you how bad it is in housing. All right, here's my number one worry for housing and retail in our economy. It's our household debt. So the New York Fed updates monthly and quarterly our annual household debt survey or report. It's not a survey, it's a report. And we just hit a record for total household debt. It climbed to almost $17 trillion. Think of that. The Fed's balance sheet's at just under 9. Household debt is twice of that. And credit card debt is merging into where it might surpass student loan debt. So the student loans, our millennial kids can point to us baby boomers and say, so you lectured us about student loan debt and being responsible and all that. What the heck have you done with credit cards? Because we're having to live off them with this inflation and these Fed increases. So how is a household to continue to consume, buy homes, buy cars, or invest under this kind of crushing household debt? We're a fiat economy. There's nothing backing us. And our households now, which had built up savings, we're now eating through that savings. We're putting it on our credit cards. This is our number one headwind that we better be paying attention to. All right, want to call attention to our great work by Site to Do Business, CCIM Tech, and the CCIM Institute on the CRE Index, the Commercial Real Estate Performance Index. So here's the chart. We're a little behind right now. There was a technology issue that's prevented that from being updated for the February numbers coming into March. So we just have the end of the year numbers, but it's going to get worse. So our all-time low in the CRE Index, when we back tested it, was 84.2 in March of 2009. So the Great Recession. We broke down and broke a new record at just under 82 in October of last year. We came back up a little bit to the 82, 83 range. My forecast is we're probably already back below 80, and that we will break every record and go maybe into the 70 range this year when you think of the elements that are the forward-looking windshield indicators that comprise the CRE. University of Michigan Consumer Confidence, NHAB Wells Fargo Housing Market Index, the JOLTS data, the S&P 500 Index, what's happened there in the volatility, the Green Street Commercial Property Price Index. Half of these indices are probably down 25 to 30% from our year-end numbers that gave us an 82, 83 range. So I think we're below 80. This is a great all forward-looking windshield indicator index. If I could redo anything, I would say to our friends at CCIM Tech, Mark and Stan and Carol, we probably should have had the foresight to put the Texas ratio in there to look at what percentage of our banks have a ratio that are above 5 or approaching 10. But this is a great tool for you guys. It's been incredibly accurate. It's easy to understand. You can send it to your clients, site2dobusiness.com/CRE. I write a narrative with each new release that we do. This was the one I wrote in January for the year-end numbers. It said my 2 big concerns before the SVB bank failure were our job cuts and loan LTC, the timing and capital piece before this all blew up. So this is a great tool. We own it. We should promote it. We should talk about it. We should send it to our clients. It's one of the really good sliced bread things that the CCIM Institute has invented over its many decades. All right, let's talk about commercial real estate values, because that's what ultimately we're going to worry about here. So this is the Green Street version, which is the institutional quality. And we saw before the beginning of this year that all of the commercial real estate values had peaked. They were coming down. They were coming down for one reason. Expenses were growing at 3 times the rate of rent growth. So that results in your NOI coming down. So even at the same cap rate, values have to correct. And look at the latest numbers there. Who has one of the highest declines, even up there with office, is multifamily. And then look who has the lowest decline, and that's hotel. And it's all because of Carl or Boudreaux. He fed all the hotel folks good Cajun food, and we came up with a good Cajun name to explain hotel, and that's called Boo Leisure. It's business and leisure. So when I travel now, if I can add on an extra day of leisure, so if I go to Salt Lake or Bozeman, Montana, I'll be heading to Florida soon, or the coastal areas, the Atlantic and Gulf Coast, if I can tack on an extra day or two, because I can work remote and I can decompress and still do some work, I'm adding more business to a leisure hotel stay. And so those hotels that can offer you both the business and leisure elements are just crushing it. They've cut expenses. We all check in remote with an app. There's no more food. We don't get maid service every day. So they've cut their expenses by about 1/3. The revenues are way up, and Boo Leisure is the thing that's really working. This will be the first recession since World War II that we've really tracked this stuff in commercial real estate, that hotel, it's my prediction, hotel will not go into recession. It'll perform very well on that side. So here's the Real Capital Analytics version that just came out. And I want to call your attention really to the 3-month chart, and then look at the 1 and 3 year. So look at even industrial, according to Real Capital Analytics, is went down 1%. Apartments down over 8%. I believe that's more realistic than the 20% extreme by Green Street, which is mainly New York, San Francisco, Seattle, big market, big urban assets. It's more broad-based. And then look at all metro types. So all property types are down 6%. Year over year, and multifamily is the worst at 8%. We're already seeing this correction. We're already starting to see the next thing that's going to happen, which is the correction in cap rate. Just like the repricing of bonds in Silicon Valley Bank, you got to reprice those bonds because interest rates have gone up. We're going to reprice commercial real estate because cap rates have gone up. And remember, a cap rate is just the inverse of a stock multiple. And so when you cut the stock multiple, you devalue the asset when the multiple goes up. It's just the inverse with the cap rate. Cap rate goes up, value goes down. Cap rate goes down, the value goes up. All right, so here's another one I want to you to pay attention to. TREP, who tracks all of the CMBS permanent loan debt, not only here in the US, but in Europe. They also do all of the stress test analysis for all the banks before they turn it into the Fed, and for the non-25 large banks that are required to do it. So everybody else from 25 on down to like 5,000, TREP enables them to do this. And here's the latest instructions from the Fed before the Silicon Valley Bank failure. And it was that the Fed wants the banks to stress test all their commercial real estate, assuming a 40% decline in value. Half the banks are insolvent. When you look at the CRE concentrated banks, the amount of commercial real estate in banks, even if it's only 20 or 25%, that when you put a 40% decline stress test, all these banks are going to need to raise more capital. They're going to need to put more money away in the loan loss reserve allowances for problem loans. That means they're going to have less capital for lending, and they're going to be less inclined to lend on commercial real estate. This is a wake-up call. And these stress tests will play out, and we'll get the first readings on them by the time the Fed gets into its May, June, and July meetings, and then definitely by the fall. So this is an important one to look at. The American banker, will commercial real estate loan losses be next problem for banks? This is the one where I said, are you kidding me? What was the idiot that wrote this headline or didn't understand how obvious this thing was? This is the next asset class that has fixed interest rate assets that are being hit by these rate increases. So this goes, I think we should just give an honorary award to Greg Lescoti. We didn't know how valuable this post that he did last year would be and how insightful it would be. But as an appraiser, I learned this very, very early, 30, 40 years ago, the band of investment. So we're going to see a lockup of transactions. We're not going to see cap rates. We're not going to have that transparency. So how do we determine the cap rate? We look at the cost of capital, the equity and the debt. And we do a band of investment. And what we can see is, as Greg showed here, January of 2021, we could justify 5% cap rates. We could get 70, 75% loan to values. We could get low interest rate deals. The treasury was down. Everybody's willing to lend. Fast forward to this analysis they did last fall. If you look at it today, the rest of your hair or mine will fall out, but you can't even get to a level that we construct a 7 3/4 cap rate. You're probably looking at 8% plus cap rates today on the cost of capital. The loan to value has been cut from 70 to probably 55, 60% max. Every element of the band of investment, the mortgage constant, the debt, the equity pieces have deteriorated, which means we're looking at going from 5 cap rate range to almost 8. What that means, when you go from that 5 range to a 7, 8 cap rate range, is you lose 25% of your value. So we just lost 10 to 15% from expenses growing faster than rents because of inflation. Now we pile on another 25% because of the cap rate change. That's how we get a 40% decline in value. That's how you get a Silicon Valley bank issue or bank failure in a CRE concentrated bank. And I think we have at least in the range of 200 right now that are in that range. And we could rival what we saw post 2008 and 9, which was over 500 bank failures because of the Great Recession and what happened from the subprime mortgage crisis. So we've got 5,000. So can we lose 10%? Yeah. But is it the 10% in your backyard, in your transaction? And what does that mean for the Fed having to backstop and now implicitly insure all of these deposits? You also should know about a program for your clients that can help them, because many of our small businesses and our tenants, we have to accumulate payroll. And that payroll can easily exceed $250,000. That's what happened with Silicon Valley Bank, and why they had to backstop all of those deposits was all the payroll had been accumulated for payroll on March 15th when the bank failed on March 10th. And so that would have meant just thousands of businesses that wouldn't have been able to pay their employees and the domino effect from that. So there's a program called CSRS in the FDIC that allows you or a business to take, let's say you got $2 million in deposit in one bank or for payroll, and it spreads that out among about 3,000 banks. So you're insured. So I would encourage all of you, your brokerage business, your tenants, your clients, every one of us that have a business where we could have over 250,000 in accumulated cash, to look at this CSRS program, and you can get to it talking to your bank or talking to the treasury management people within your bank. But look at that CSRS program to protect you and your clients. All right, what does all this mean? It means we're going to see a slowing in commercial real estate transaction. None of us want to hear that, but that's the reality. And so again, when I look at earnings reports, I look at the major brokerages and look at their early reports and the warnings. And what Colliers, they were first out in reporting of the major brokerages, and they said, look, we're seeing transaction activity already drop 30+%, and our forecast to the SEC under penalty of perjury is that we think that we're going to see up to a 50% decline in property sales and capital markets activity in 2023. So you've got the stress test, you've got Green Street, you've got RCA, and now you've got public companies like the brokerages saying, this is really going to be a tough year. So all of us need to right now, not necessarily be scared, but we really need to be taking and doing preparation activity, because I think when it comes May, June, and July, we have another March 9th, March 10th Silicon Valley Bank failure moment that's coming our way. All right, ULI emerging trends, where should we be? So they came out with their 2023 report and they said, put your money in industrial, multifamily, and hotel. Wait, are you kidding me? So look, at hotels are in that bucket, like just everything that James Bond touches. He has the magic touch, it's excitement. Blue leisure is real. hotels will be the first time that these assets don't go into implosion during a recession for the reasons I previously talked about. So if you haven't looked at hotel or you haven't diversified, this may be one of those times. The money coming out of the rest of the world, from Vietnam and South Korea and Asia, and even out of South and Latin America, they get the hotel story. All right, office, remote to work. You know, I follow the Castle system. I've been doing this for a couple of years, looking at during the COVID. It was my bellwether, just like the passenger count at the airports during COVID. Was anybody going to fly? When would that happen? So office work, they're telling us how many of us are going back to work. They can barely get to 50%. And it's basically Texas has the highest percents, with Austin and Dallas at 50 and 56. Look at Chicago, though. Chicago's bumped back up above 50%. Maybe it's because there's free heating when they go back to work versus running the heating at home. But we are far from pre-COVID office occupancy, and I think this is going to stay with us. PIMCO is the best example. You know, this is institutional money. It had $1.7 billion in mortgage notes on 7 office buildings from California to New York, and they said they've already dropped 20% in value. They're going another 20. We're giving the keys back. We're going to see a lot of this in big markets, big urban markets where the office market's been hit hard, where most of us don't want to go back to work. We don't want to commute. We don't want to pay for parking, dry cleaning, try to find a restaurant when there's nothing open or no service, all the services that we used to enjoy in offices. And look at what they point out at the bottom there. I've highlighted. U.S. offices, particularly older buildings with fewer amenities, have struggled in this remote work. And so we don't see that. I just been to New York, and I was just appalled at how little I could meet with clients in New York, because restaurants weren't open, or if they were open, they only had 1 or 2 servers. It was a 2 or 3 hour wait. I've told them, look, come to Atlanta, come to North Carolina. We'll hold a meeting there. Everything's open, everything's staffed. But I'm really struggling with how New York's going to come back from all this. All right. Commercial real estate has a shock coming as return to office plans fail. So we're seeing more and more CEOs say, look, this just isn't going to happen. They're not coming back. But there was a James Bond movie that said, never say never. So maybe in 5 years, everybody decides we're going back to work, just like everybody wanted to go do the urban life thing and didn't want to go to the suburbs. Never say never. But right now, I think this is a watershed moment, just like when the GIs returned from World War II and redefined our economy and created things called the suburbs and regional malls that defined our commercial real estate landscape for decades to follow. I think suburban office is strong and doing well. Urban, not so much. And I don't think the going back to work mandates are gonna play very well. All right, retail. What's going on with retail? We're not done with retail apocalypse. In 2019, we had the most number of retail store closings, over 9,000. We've already had over 1,500 the first 2 months of this year. And look who's closing stores on the left there. These are big names that are in fiscally good shape. Walmart, Starbucks, Walgreens. And the reason they're doing it is they all mastered omni-channel, multiple ways to sell and reach a consumer. And now it's about omni-channel. Of all those options in stores, which ones do I close? Which ones do I maximize efficiencies? One encouraging sign in the bottom right there, all of these Bed Bath & Beyond closings and store closings, they're being snapped up. They're in really good locations. They're divisible, you know, in a couple of different bays of 20,000 square feet. None of them are much over about 40,000. Small is the new big. And so they're a pocket, and we're not building big box. We're not building new malls. So to the degree you need some of this activity in the suburbs, especially where the U-Haul workforce has moved, these assets are being picked up. So that's an encouraging sign. All right, so what's going on in retail? Number one, it's grocery. If you've got a center with a grocery store and it's 1 or 2, maybe number 3 in market share, it's doing well. Life companies will lend on it. Banks aren't yet, they're pulling back in, but there's institutional money that will lend on grocery. Small store contests, small is the new big. And then what I just mentioned, the Opti. Here's the list of the top 100 retailers in America. And look at how many of them are grocery in just the top 20. Walmart, Kroger, Target, Albertsons, Publix, Aldi, H.E. Butt. So grocery is really there, and they're among the top 20 retailers in the top 100 list. The retail apocalypse, again, here's the list. This concept I get tossed out of me all the time is, but K.C., we're opening more stores than we're closing. And I'm like, yeah, that's true. but they're all like 10 to 30,000 square foot stores, not 60 to 120,000 square foot. So while the number of store openings is great and greater than what we're closing, the square footage is not. So don't get sucked into that. We're opening more stores than we're closing. The square footage that's being thrown back in the market is a multiple of what we're opening on. Another one that's interesting is look at grocery in dollar stores. This might shock you. It shocked me when I just saw this, but it was a new report that came out by CoreSite, and they said that 1 in 5 consumers now buy their groceries at dollar stores. Think about that. So it's either they don't have the gas commute, they view it as a bargain. These dollar stores are expanding where half the square footage now has cold. You can get milk, you can get beer, you can get produce. So look at as an opportunity if you're in retail, look at these dollar stores, because this is one of their boom times. They're doing very, very well. And that's pretty good news as an opportunity in retail. Small store strategies. So here's a couple examples with Macy's and Nordstrom's and Bloomingdale's, where they're working at new smaller concepts, and they're working very well. And if you think about it, I don't need the redundancy of mall stores that have 80 to 100,000 square feet. When I can do a few small ones, I could maybe move into a Bath & Beyond and have all the visibility and all the returns, and I can have an e-commerce warehouse that can enable me to close 50 to 100 department stores. And so small is the new big in retail concepts. So don't ignore or overlook the small or things like the Bed Bath & Beyond store closings. All right, where's the opportunity? You got to find where you have over 7% growth or population growth, and that's the U-Haul migration report. It's south, it's intermountain regions like your region there, really from Idaho all the way down through Utah and Colorado. Montana, I don't know why you're not on there, but I was just back there. I swear to God, everybody had a California accent that was in Bozeman, Montana, and was looking to buy. They've even got, I think it's a A&E, I can't remember which one of the TV shows now has Buying Montana. And it's on every night on one of those shows showing all these Californians and people from Washington and Oregon coming into Montana to buy up properties until they find out they have winters there like this year. So we'll see what happens after that. But diamonds are forever. Our inland affordable markets is where everybody's going. It's where you can outrun inflation. This is an analysis CBRE did where they used BLS data and updated, and the dark blue there represent the areas where you're seeing maximum growth, population migration. So you can see Idaho, you're doing very well. Montana, I just don't think they've caught up with the numbers yet. Colorado, very well. Washington, Oregon, very well. Then you can see the dominance in the South, and then you can see the red where they're leaving the Northeast, they're leaving Southern California, they're all going to Montana. They're all going into your region 1. All right, one other thing that we're having fun with in the James Bond movie Moonraker is Spacenomics. So our firm copyrighted this term. We're working on a major paper to identify the significance of the space economy to our overall U.S. economy. And today it's less than 1% of our GDP. One of the findings in the paper that I'll publish later this summer will be that I believe that within 5 years, the space economy and Spacenomics will be 10% of our GDP. And you can already see the number of jobs. Florida will have a record 90 space launches this year. Now put that in perspective. There's only 250 satellites that are orbiting the Earth with everybody, China, all of Asia, Russia, us, 250. And we're going to have 90 new launches this year into space. We're going to have a lot that we're going to have to do. We have to figure out the logistics, supply chain, who owns the orbital rings so they don't cross in front of somebody else's satellite. There's a lot of opportunity on real estate, the manufacturing of those satellites and the systems and the coding of all that. There's going to be tremendous opportunity. The states that I think are dominating now that'll probably be in the top 5 will be like Florida, Texas, California, Washington State, Colorado, even Arizona, just out in Tucson. They've got over 15 of the largest space aero defense companies in Arizona. So we'll have more of that in the fall. I think you'll find it exciting. So I'll close out here, and I think we'll have time for a few questions. How about that? I'm 10 minutes early. So we just wrapped up March Madness. We're getting ready to go into the NBA playoffs. So my son loves basketball. There's Luke on the left. I can't believe I got a picture of him with the ball going through the net. And so we had a great time watching the NBA All-Star game. If you didn't see it, go look at the clips on the slam dunk contest. So it was this unknown guy by the name of Mac McClung. had a 2-month contract with, I think, the Philadelphia 76ers. His first slam dunk was to jump over 2 people, 2 grown men, holding the ball over their head and do a reverse slam dunk, 360 slam dunk. Absolutely incredible. Perfect 50 score. And then his next 2 attempts were equally as impressive with 50 scores. And so he won the competition. None of the super celebrities would even do it. This kid was incredible. And what it means is, even in the most challenging times, even though you're the most unknown or you don't know where to go, you got to line up your shot. And hopefully I've given you some ideas here on why we really got to line up our shot. This is going to be the year that we thought was going to be 2021 or 2022. Because of the fiscal injection of capital by Congress and the Fed, $22 trillion. They let us skip 21 and 2022 with COVID. We're now paying the price. That's what we're going to have to face this year. We're going to have to figure out capital solutions. We're going to figure out how to survive, how to serve our clients. Capital is going to be locked up. Maturity defaults are going to be a big issue this year. But there's opportunity in markets. There's opportunity if you can bring capital, tap private equity. So don't give up hope, but I do want you prepared. I'll never sugarcoat anything. I'll always tell you and give you the resources to go to, like the Texas ratio, to make sure you're not a week out from a closing with a seller's using a bank that has a 10% Texas ratio and is at risk of failure as the stress tests come out May, June, or July. So I'll stop there and stop sharing and see if we have any questions or anything that we want to talk about. Back to you, Karen. Did I cheer you? Did I cheer you up? Are you ready to take your medicine?
I know. I was like, oh no. Is there any good news? And I actually wanted to ask a question. We do have a couple other ones as well, but what about medical? What do you see there?
So I do see good things. It's just the capital piece that's going to be hard. I want to show you one other slide here. I think it's still on here. I thought I was at the end. It's this one on the upcoming webinar. So you guys, Region 1, number 1, got number 1 webinar. We have 5 more of these coming around the country. It's not going to be the same deck. I will refresh it every time we go through. So be sure to maybe think about joining if you have the time, because we'll be updating everything that's going on in the Fed and if things are moving or not moving. So pay attention to those. So I'll leave that up for a minute. So medical is great. I mean, the demand is there. We're aging. We're getting old. We need care. The problem is, in this inflationary environment, I was just at a senior care facility that had independent, assisted, and nursing care, and their rates from a year ago are up 20%. And it's all because of wages. It's a very wager intensive nature, and it's also because of insurance. So the wages and the insurance items have caused. So if you're thinking, I had my parents both go through this in 2001 through 2006. We were paying $5,000 a month for each one of them. Today, try $10,000 for that same care treatment. So the medical is going to, we're going to see medical dispersed in a different way. It's not going to be just hospital campuses. We're seeing things like branch banks being adaptively reused to be disbursement centers for clinics or testing. There's a lot of opportunity in adaptive reuse as the medical system kind of gets dispersed. But like all these property types, where's the capital going to come from? And the banks have no imagination. They're pulling their horns in, and that's the biggest challenge. And remember, medical office takes a lot of non-realty items. So think of the TIs, the doctor equipment, and the banks are just very nervous about putting that kind of capital investment. So the demand fundamentals are there. The demographic fundamentals are great. It's just, where's the capital going to come from?
Okay. I'll go on to a couple of the questions that we have from the audience. This is from Travis Baker. Can you address the expected impact of the recent test cases that have been underway for a digital currency, and whether or not this will hasten the push to adopt a digital dollar?
Yeah, so I tell you, before the FTX collapse and the Fed's being AWOL for a decade on crypto, that we were probably heading to a digital replacement of the US dollar as a reserve currency. I think that's been set back many, many years here. Although it's puzzling to me, I can't explain why Bitcoin has gone from under 20,000 to almost 30,000 during this banking crisis. That we would think that something with like crypto and Bitcoin would be more safe than an FDIC insured account. I cannot explain that one. I give up. I think we'll get back to it. I think it's been set back 2 or 3 years at least. It's efficient, the digital ledger, how we do transactions, how we reduce the labor component, but we've got to have transparency. And the Fed didn't do its job on regulation. They didn't do its job on basic bank supervision, like concentration risk, just understanding how their rates affect the asset side of a balance sheet. How in the hell are they going to ever figure out crypto? I kind of give up on that side. It's been set back. I wouldn't be putting any of my capital to work in it right now. I think there's too much to come. And I think there's a deluge of regulation that's going to come that's going to make it difficult to function.
Yeah, it seems like video game money.
There you go.
Yeah, this is a question from Ian Levine. So for somebody who has already invested into a multifamily development with cash, but hasn't pulled the construction loan for the major development, should the developer hold and wait, terminate the loan, or draw the funds and proceed?
Yeah, that's a tough question. So if the Fed's going to stay on a rate hike cycle, we're probably not going to know the answer to this question until May, June, or July. So if the Fed keeps raising rates and says the hell with banks, and puts us in that pickle again, you don't want to be pulling that construction loan. Remember, it's a floating rate, or it's tied to SOFR. So remember the old LIBOR rate and how stable it was, and it never went much above, quarter, half, maybe 1%. SOFR has been running above the 10-year treasury. And so the construction debt is really difficult today. We may find that equity is cheaper than a bank's construction loan. I would say right now, if you can function with the assets and put it on, I think you're going to find two things. Number one, the construction costs or rehab costs, if it's a value add deal, are coming down. When you shut down the residential industry, the residential home building industry consumes about 40% of all materials. So we're seeing material prices come down on copper and concrete and, asphalt. All those are coming down. So you may actually see his material costs come down by continuing to watch and rebid. I may also see the labor costs come down with the lack of construction. Number two, I think we're going to see some innovation in construction financing, and that we may see some different products. Follow the auto industry. Remember how the auto industry always deals with things about the payment or how we get the variable down, and we push it all out. Think about CMBS in 2009 and 10. We did interest-only deals and kicked it down the road. We're going to see some innovation on the construction side to move some of this forward. I would be risk averse right now. I think there's too much we don't know between now and May, when the Fed comes back and we see what are they really going to do, and what do we see in CRE concentrated banks, which were large construction lenders. So he could get pulling forward and get down the road with a bank that fails or that has a disruption in the construction process. I'd be risk averse right now, and if you've got the capital to be patient and hold, I think you might be rewarded. Lower overall costs, and I think that then we know what the Fed's going to do, because if they go on to like what Volcker did, you sure as heck don't want to have a construction loan that then comes out into a permanent loan and there's no money for it, or you're looking at 10, 11, 12, 13% money, which is what happened in the late 70s and 80s. That's what happened to my father delivering condos in 1978. He decided to pull the trigger on the construction loans, and Volcker went forward, and he ended up with construction loans that went from the 6% range to 13% range, just about bankrupted him. So I'd be risk averse. From my experiences, I'd be a little risk averse.
Thank you. And so if you were talking to the Fed, how would you tell them to fix this, or what would you recommend?
I'd call Donald Trump back and ask him to hold one more boardroom and fire all of them, whether you like Trump or not. This honestly is the most incompetent Fed. If you want to follow one person that's been spot on all of this and was nominated to be a vice chair and governor at the Fed, it's Judy Shelton. She's phenomenal. And she's on CNBC about once a month. And she walks through this stuff and the mistakes that they've made in plain, simple language. This really is a terrible Fed. And we're seeing key people retire. Esther George from the Kansas City Fed. I worked with Esther. She came into the role after Tom Honig retired. Jim Bullard, he wants to take things from a 5% overnight bank lending rate to 7%. He was right a year or 2 years ago. Right now, we can't do that unless we want to destroy the banking system and the economy. But Judy Shelton is one voice I would tell you to follow. I think it's unfortunate Jay Powell was just reappointed. He's got 3 more years to run. You got talking heads like the Atlanta Fed, Bostic, that all he wants to do is DEI and ESG and has no idea what's going on in bank supervision. And when I was at the Atlanta Fed, the bank supervision was so close then to SunTrust Bank, they actually lost bank supervision. For almost a year, it was transferred to the Richmond Fed to take over because they were too cozy and too corrupt on the process. And every entity and executive in the Atlanta Fed and bank supervision was ousted. That's what's going to happen in the San Francisco Fed as well. And we don't know how many more of those that we have out there, but we have a shortage of really talented people like a Richard Fisher that retired from the Dallas Fed. Esther George is retiring right now. But this really is not a Fed that gives me confidence. When they think that they can raise interest rates 9 times, 8 or 9 times, without pausing to even talk to bank supervision about what the hell is going on with banks' balance sheets to know how many are going to fail and their assets are below their liabilities, that's just mass incompetence. You and I would be fired for anything close to that running a Kool-Aid stand, not knowing that there's enough lemonade and money to go buy a replenishment. Absolutely incredible.
Yeah.
Sorry, I don't have any opinions on the Fed.
Yeah. Well, K.C, thank you for sharing your experience today. I mean, a little doom and gloom, but we really appreciate you sharing this on our webinar. Thank you everyone for attending as well. As a reminder, the recording and accompanying presentation will be emailed to all registered attendees. And if you're not already a CCIM member or course participant, take a moment to sign up for our e-newsletter at ccim.com to stay informed about complimentary webinars like this one, as well as all the other professional development opportunities. And have a great day. Thank you.
Yeah. Thanks, Karen.
Thank you.